We've just gone over these questions here in part 2 video. We'll review them. So far in the first two parts of the video series, we've answered the question, what is the source for the techniques? Answer is the massive expanded course material, discussions with Alan, sometimes at his kitchen table, and our research. What did Andrews write was best for getting in nearest to a reversal point? The answer is the OR method. He wrote about that in early 1974. He wrote in extensive detail about how it's used. Then he said it was only to be used by nonprofits and hospitals or something like that, educational institutions. He called it the OR method because he thought it was golden. It was like gold or something. So how could Andrews have known days in advance where to place orders? Answer is one way we can know is by looking ahead to see where specific signals would be true in clusters. He could have done this subconsciously. This can be done consciously, and I show this is done consciously when I send stuff out, and I have several numbers on the charts and stuff. So okay. How to find a large move? What did Andrews look for first? So before, when he wrote his newsletter, before he would select a commodity to trade for the next month or two, he would find one that was making a major pivot effectively. How scarce is the expanded course? 100 in total, with the cost increasing with each one purchased. Let's move on. Where did the median line start? Was Andrews just sitting around with charts and draw a median line? Not really. What happened was Professor Andrews was teaching civil engineering at the University of Miami, and sometimes he would discuss his previous life as a cotton trader and how his father wanted him to make $1 million in the first year. Well, that really didn't happen the first year after he graduated. He told me that it took him 3 years. Considering the fact this was about 100 years ago, it was an absolutely incredible feat. During the instruction in the class itself, professor would discuss his relationship with Roger Babson, George Marischal, Birdseye, that's Birdseye like in frozen food, Zagorski like in helicopters, and Morse, who was he was related to Morse code thing. Okay, and so he discussed that. And during a class, the professor at the university, he might have discussed the Babson chart. Now, the Babson chart was pretty well publicly known, and Babson was known for that, even though this particular technique probably didn't work real well. And his action-reaction theory at that time suggested that this was a normal line, and that when prices would spend so and so much time above the normal line and then go below the normal line, and when this area above the normal line was equal to the area below the normal line, they would then take off and go above the normal line again. If you look at it, even blow the chart up and look at micro square centimeters, it doesn't work really well. But Babson did have stuff that worked really well. And let's move on. There we go. Babson discussed his theories in greater details at regular meetings of the Gravity Research Foundation, which, by the way, is still alive and well today, where Birdseye and Zagorski would join the young Alan Andrews in listening to presentations, and they'd all have their feet like up in the air in order to minimize the impact of gravity on them. And that was kind of different. So anyway, still to this day, this particular association is alive and well, or foundation, and they pay people large amounts of money for submitting impressive papers on their research on gravity. Okay, and so you can Google Gravity Research Foundation someday and get really impressed by the caliber of people that are now still to this day submitting papers. But anyway, at the meetings, Andrews learned the steps necessary to determine future probable price reversal areas that Roger Babson only discussed privately. So, and And so first he would, tell him to draw a normal line. Okay. And then after you draw this normal line, you might call it a center line, because that's pretty much what we're going to call it from now on. You find a previous point where price is reversed, and you draw an action line there, and the action line is really parallel to the normal line. See? Okay. And then the next trick is take the distance from here to here, flip it over into the future. There you go. And so here you have it, and here's your reaction line, so we call it. And quite often what you'll have is you'll have a nice reaction here. Okay, and this was FXI China ETF. Now, truth be told, at the time we didn't use this chart here is from eSignal. We didn't use the software that much from the wonderful world of eSignal. Instead, we predominantly used Precision Trader. And let me show you what chart we looked at on Precision Trader. We use this one here, and we sent this chart here out to the Andrews group. There's a private group of people who've taken the Andrews course, and they can hang in there for a very long period of time and submit questions, and they'll get answered privately and stuff. And what happens is we'll send them out charts like this here, for example, and they're then encouraged to apply the Andrews indicators, these more Andrews indicators, to this kind of chart to help them know what action, if any, to take. Okay. So now, one of the things with Precision Trader is it gives you the option of drawing things in a way that come out differently than weekly charts. Remember, weekly charts effectively include holidays as a day, whereas daily charts without holidays do not. And so this was the chart that we got, daily charts without holidays, and prices nicely came down to the reaction line and reversed. And this is using software called Precision Trader 3.0, which, by the way, we give away a copy of this software to anybody who takes the Advanced Andrews course. And yes, it is a full working version. Absolutely. Okay, another example that takes this whole concept a bit further is action-reaction lines. Okay, so you have a center line or normal line, then you take previous low points, for example, if you have a downsloping center line, and then you draw the equidistant further out there reaction lines. Isn't that cool? So you do that, and there you go. Okay, now here's the semiconductor index, and here you see the action points, and here you see the reaction points. Okay. And let's do a recent chart, because as they say, when you do historical testing of any kind, you take a period where you do the historical testing on, and then you take a more recent period, and you see if it worked there. Okay, it's kind of a walk forward test. And so what happened was, back in 2011, I have this chart here, and I drew the peak to low, right? And so I drew the peak to low line, and here you have your peak to low, and here you have your action, and here you have your reaction. Here's your action, and then out here is going to be your reaction, and we'll see how this works. Here you go. Here it is again, and here we go. And here's our peak to low. Here's our action, reaction, reaction. Okay? So with the action lines, we can see that they would have helped in knowing ahead of time where reaction is probable. Should one buy or sell every time prices reach these lines? Probably not. You want to use it in conjunction with the other indicators. And this, by the way, this was the top in gold in the end of 2011. And at that time, we also had another indicator coming in right here. That was a reaction line too. So that's how we do things. We have a combination of indicators coming in. Okay, so getting back to what we were talking about now, Andrews was in class, and he talked about to his students about action-reaction lines, and this might have been a kind of a chart that they would have posted, and questions probably came up in class, and they would have included, after prices pull back to a reaction line, how do you know when to buy, and how do you know which type of center lines to draw? Because there's different types. There's this variety of types. So, and if prices break past a reaction line and start going off to the next one, what do you use to know you're still with a trend? Well, in the back of the room was a rather smart kid who possibly just got out of a statistics class. Anyway, he says, "Hey, how about a regression line?" I'm going, what? Well, apparently this is a chart we took from Wikipedia, and if you Google the word on Wikipedia regression line, you'll get this chart, and then you'll get this big elongated explanation. And here's what it really says: is you use the mathematical formula there, and you can, with this much data here to this horizontal line, you can say, hey, this is the slope. You can draw this red line, and then you can just take a ruler and pop it over into the future. So let's look at the pitchfork. You have a low, high, low. That's what you're using the median line rather than the regular regression line formula. And then you have this here, which gives you a point. Let's say if you started behind here, you would have been able to draw your median line, and it goes out into the future. Now let's say you have software like that comes with IB, for example, and you can't really draw a median line with it. Not a problem. Here's how to do it. Most software will enable you to draw a trend line, will enable you to draw a parallel trend line, and they'll also allow you to find the 50% point, Fibonacci ratio thing. Okay, so you just take this high here, this low here, find the 50% point, boom, and from this point here to that 50% value, just draw a line straight out, and you got it as a trend line. Then from the trend line feature, it allows you to draw a parallel line, another parallel line. Voila, you're in business. Okay, so Andrews researched the median line, and he found that prices hit the median line nearly 80% of the time. Under specific circumstances, when prices did not make it, a powerful move would go in the opposite direction. Also, when prices zoom past the ML, they would typically go back towards it and then go much further in the original direction. Let's take a look. Here you have a zoom of the ML, retrace back further in the original direction. And here's a recent silver chart. Zoom of the ML, retrace back further in the original direction. Okay. Now here's an intraday chart. Yes, this does apply intraday also. Here you had an OR reversal. Here you had another OR reversal. It's around the 1200 level, and as you can see, prices zoom through the ML here, retrace back, and then we'll see if they went further in the original direction in a second. And as you can see here, if you drew your new ML, which is this one here, this one here, this one here, prices went back to it and reversed. So let's see what happened after they made this 1200 low. Let's see if it kept on going or dropped. There we go. Here's where the 1200 low was, and then here's where the zoom and retrace, and then on we went. The rest is history, right? Now, Andrews developed a course, and to market the course, he would advertise in Popular Mechanics and other magazines, and he would send responders a weekly course letter. Typically, his advertisement would say make over 100% a year, things like that. Let me show you how. And so he would send them this newsletter for like a period of 8 weeks, where they turned 5K to 50K. Now, truth be told, most people probably didn't have a commodities account that was open, and put up their money and turned 5K into 50K in no time at all. what more than likely happened was they just stood there, read this thing dumbfounded, and holy smokes, another drink here. Sure beats coughing. Okay, so in the 1980s, he suggested that I teach the course. I developed the software for it called Precision Trader that we give away with the Andrews course, Andrews Advanced course. And I was fortunate enough to acquire the massive library of the trading techniques and course letters that you saw that are piled all over that table in part 1. And you can now see it on YouTube by simply searching for The Treasure of Alan Andrews. Now there is a limited availability. Only 15 of the advanced course members only 15 new advanced course members each month. And I do this because I really want to keep things kind of sane. A limited total of total expanded course members, and this is a limit of 100 total. Okay, and you can order the advanced course today, and you receive a 10% discount off the expanded course if you purchase within 10 days. Yipes! I wrote this here, and I just said it for you guys. So here's what we're going to do. If you order the advanced course and you purchase the expanded course within 10 days, just remind me in the email you send to me, because you're going to have to get a price, that after I send you the price, wait till after I send you the price, okay? Then you say, oh, by the way, I saw this video and I want to get the 10% discount off the expanded course because I'm buying it within 10 days of buying the advanced course. Okay? That's what you do. You get the price from me, right? So here's how it works again. When you buy the advanced course, okay, you can buy that online. Click, no problem. And then you get a price from me on the expanded course, and you need to do that within a few days, okay, of ordering the advanced course. And so what happens is if you do this all within 10 days, then you get then what you do is you get a price from me, and then you say, oh, by the way, Ron, I get a 10% discount off the expanded course because I'm doing it within the 10 days. And then, so you just subtract that amount and you say, hey, how about this amount here? And I go, okay, that's what I agreed to, so I'm sticking with it. So that's what we're going to do. Okay, let's move on to some techniques. Ready? Hold your horses here. Here we go. Don't worry about taking lots of notes. You can see this in Hagopian's rule. You can see this kind of stuff again and again using the YouTube video. Besides, in the advanced course, we'll have better stuff for you. Okay, Hagopian's rule, and this is all over the web. Basically what it says is if prices don't make the ML, it's going to go a whole lot the other way. Well, yeah, that may be. And it also says, Hagopian's rule says, well, you draw a trend line. If prices break through, you buy here. And then take the ride up here. The only problem is that this is one heck of a drawdown from 1250 to under 1200. If you look at these numbers of bars, this is nearly a month. Yipes! Now, here's what Andrew said in one of the Andrew's course videos that we have, that we send out to students, is that Andrew said, you simply draw your 2P line when prices make a third pivot here, and away you go. That's what you do for an entry. Okay? Now, I say that's fine and dandy, but however, there is another indicator that comes in right here, and another indicator that comes in right here if you simply look at the videos in the advanced course. Okay? And the advanced course and the expanded course are two different things. Okay, let's take another example of this. Okay, so right here is where prices didn't make it to the median line. Here, prices broke a 2P line, and so you have your Hagopian's rule entry. Oh, okay, that's fine. And then, if you draw your 2P line using Andrews, you have a different entry right here, and away we go. Okay, now our entry, because of the pattern right here, was over here. And that's using a standard right out of the manual advanced course technique. And this ironically comes from Andrews. Andrews had a certain rule, and I looked at it and I said, well, if you add this other thing to it, you're going to have a lot better success. And that's really what this is. Okay, let's move on. Yeah, I'll just plow through till the rest. Let's take a look at Andrews and Gann. With Andrews, Gann was really good. Now, my interpretation of Gann is simply this. You take the head, you take the neckline, and the theory, when you have a head and shoulders, here's a shoulder, here's a shoulder, here's a head, you, under Gann rules, you take the breakout to the reaction point, and I'll show you that in a minute. Okay. Here it is. Here's the head, and so when prices break this point here, boom, the ride is down to there. Okay. Now with Andrews, it'd be a little different. You go through your manual, and your Andrews entry point more than likely is going to be your what's called a golden pivot rule. We dedicate a whole section of the manual to the golden pivot rule. Okay, and there's like 16 sections, and so what happens is this winds up being your entry point, and so you have a much tighter stop. And then once it goes through here, well, heck, happy camper, because all those wonderful Gann folks are on your side, and they're all riding it down with you. So they ride it down here, and the Gann target is over here. Okay. Okay, so now remember, Andrew said that typically when prices move in a pattern that's really strong, that they'll have 5 or more waves, and so, or 5 or more pivots. And so you have 1, 2, 3, 4, 5. And so down here is your Andrews exit. And rather than getting out over here, okay. But like I said, if you want, to get the golden pivot rule, you really have to have the manual. Okay, now let's see, this is an upside down head and shoulders, right? So you simply take a and if you look at this on a weekly chart, this is a pullback rule, okay? And on a daily chart, you probably could have seen this in Andrews terms as an end of trend reversal as a reversal rule. Okay, so anyway, you would have gotten in over here, and then you have your Gann entry over here, and your Gann, if you simply do the flip-flop, your Gann target is over here, and your Andrews exit would be up here. Now let's take a look at when I originally wrote this article that was published in Traders World about this thing with Gann and Andrews and stuff. And when I wrote it, prices were over here. And so I wrote it, and sure enough, look at this beautiful head, pretty shoulder, right? Goes down, up, and down. Isn't that nice? Okay. Now, one of the things that I like to do is when I send out a chart to people, I might put 1 or 2 lines on it, but not much more, because I don't want them seeing a whole bunch of spaghetti on top of my chart. And so what I do instead is I put a bunch of numbers over here. Now these numbers are really, really relevant, and here's why. Originally, Michael Rada did a study, and he was getting his master's for the University of Vienna. And so Michael did a study, and he found the one thing that all successful money managers had in common, and it was taking my course when I used to give it in Vienna. And I used to do this stuff live all the time. Now except for once a year, it's mostly by video. And so what happened is Michael discovered this, and then I went a bit further, and I said, well, what people are using isn't necessarily the same, because one guy loves to use this stuff with Elliott wave, another one loves to use it with RSI, another one loves using it with stochastics, and then there's people who are probably using it with what is it? Larry Pizzavento's ABCD and his other fancy pattern butterfly and all those neat kind of things. So because those things would work well with this, because they give you a different point of view on when, for example, a reversal is likely to occur. Okay, and so that it would be interesting to do a study on that to see when they coincide and how well things work out. Anyway, so what I do is I put a bunch of numbers over here, and sometimes I'll put some letters over here. But the numbers are kind of neat because what I did was I went out and surveyed course members and found out what they were using, and I got a general idea. I didn't really want the specifics, just a general thing. And but it was specific enough to know which course lines and which course indicator they really liked the best, which one was their favorite. And so what I did was in finding what their favorite was, and then I told them how to easily understand when they see one of my charts here with these numbers underneath here, the their favorite indicator is one I use to make this determination here. Okay, and so for example, when a certain person down in Tasmania looks at a chart and he sees these numbers here, there's a number 2 and the number 4, he sees a 2 and a 4, he knows what that means. And if you take the course and just communicate to me what in general your favorite is, I don't need to know your exact approach at using the methods, I just need to know in general. Then what I can do, as long as it's specific enough, then what I can do is I can tell you what number to look for in here, or numbers that would be helpful to you, so that you know when I post one of these charts, hey, I got to look at this guy, I got to look at it with my indications, with the way I, by drawing the lines and to see what I see here. Okay, so let's move on. What exactly were the buy and sell signals Andrews taught? Well, sometime, as near as I could gather, he didn't teach this or show this in the newsletters until the 80s. And I sometimes wondered why. It's really good for the breakout method. Let me show you. What he would do is he would look at alternate closes. This was kind of in between close, high close, low close, high close, low close, low close. And then there's a high close. And so when he found, let's say, that this point here, using his regular stuff, was highly probable to be a turn, then what he would do is he would simply go, okay, high close, high close, and draw a downsloping median line using the closes. And if as prices broke past this MLH, that would trigger a buy, and my guess is he would probably use the area to close on the other side of the MLH as his stop. And so this would be a buy here, okay, and prices go up, and let's say prices go up here, and once again you have low close, high close, high close, high close, low close, and so here you have a low, high, low, right, alternating closes, and you draw your median line and parallels, and this is poorly drawn. But if this area here was a place where you probably had an Andrews reversal point, then what you do is you simply draw your mini median line parallels, and boom, there you have your entry right there. Isn't that nice and easy? So there we go. Okay, but please understand this. Some people have the tendency to just look for alternate closes and buy and sell at every point. The only person that's really going to make rich is your broker. So you really want to use this in conjunction with knowing that there's a high probability point here of a reversal, and same with over here, before you put a sell in over here and a buy in over there. Okay, let's see how we're using this in this day and age of kind of having a sense of where prices might turn before the signal. Now this is a weekly chart of Magic Investment Corp, and this is a chart I sent out to the group. And there's an Andrews group where we kind of discuss things and send charts back and forth. And what happened was the prices were above this little blue line here. When I drew this little blue line in, that's usually, people usually figure, hey, Ron's looking for something to happen at that line. And yeah, that's true. And so and then I drew these, put these numbers in, And so the idea was that these indicators here are true when they hit this number. Okay, so let's look at it on a daily chart. And so yeah, prices did go down. Now prices, if you notice here, were probably pretty much falling like a knife. And this was also at the time that the S&P was falling like a knife, right? This was right before Thanksgiving. And they were coming down to 1250 or so, or was it 1200? 1150. Anyway, falling like a knife. So so after prices reversed here, this was the OR. It says Jaenisch reversal line, but that just means it's a daily OR line. And so I'm using the daily ORE line, and here we go, and there she went. And so let's take a look what actually happened afterwards. And so afterwards, prices just kind of, here they reversed, and then they kind of did their little thing. But this is just to illustrate that it is possible to ahead of time say, hey, look, when these things here are all true, which would be at this line here, then I'd be interested in looking at this at a buy or a sell. Okay, or actually in this case it would only be a buy. Okay, let's go to the last one. How did Andrews make such huge gains? Truth was he pyramided in some cases, not in all, but in pyramided when he was doing commodity trading, because sometimes he would only have one or two commodities that he was in, and so then he would pyramid. So what would happen is he would draw his action reaction lines, and as prices came down to a reaction line here, let's say, or here, he would wind up buying again, taking the ride up. Okay, he was absolutely impressive individual in terms of the stuff he did. Let's answer the quiz questions. How many years did it take Andrews to make his first million? Answer is 3, as far as I know. That's what he told me. Now, why does the median line actually work? Because it's a regression line. And how can Andrews improve Gann's head and shoulders technique? Answer is simple: better entries and exits. If prices do not make it to the median line, what are the entry signals to reverse? Well, remember Hagopian's rule, which is all over the place, that people have written books about and stuff, and said that you break of a trend line, but Andrews said wait until prices come back to a 3P line and then take that. And if you're in advanced or expanded course members, you've got textbook things to look for that are probably easier and probably get you in earlier. Okay, so what indicators are useful for finding the end of the move? Answer is reaction lines and certain other Andrews indicators, like the ORE, for example. What indicator would Andrews look for to add on position? Typically, the using a reaction line was first. And what indicator did Andrews say to use for buy and sell points, and how were they stops placed? And the answer is in the 80s. He would first find a likely reversal area, and I think he must have put this thing in there to please someone, because it wasn't anything like he did in the early 70s, where he was really up there and with it. So the answer is mini median line parallels drawn using closes, not extremes. Okay, and then he would, when prices break out, he would use that as the breakout buy indicator, or sell, whatever's appropriate, and then probably use a close on the other side of that line for an exit. What is our source for the technique? The massive expanded course material, personal discussions I've had with Dr. Alan Andrews, sometimes at his kitchen table and sometimes at seminars, and our research in the massive volumes of Andrews' writings. How did Andrews, or what did Andrews write was absolutely best? And this was in 1974 for getting in nearest a reversal point. Answer is the ORE method. How could Andrews have known days in advance where to place orders? By looking ahead to see where specific patterns would be true in clusters. Okay. And then to find a large move, what did Andrews look for first? And the answer was he would look for major pivots, and he would look for reversals at major pivots. And they were usually easy to find and forecast with his methods. And how scarce is the expanded course? Answer is 100 in total, with the cost increasing as each is purchased. So I thank you for your time, and that's the end of number 3. Oh, by the way, where can you get more? No problem. Just let's take a look here. Just go to andrewscourse.com. Okay? Thank you. See you in the course.